Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to carry on with the theme we've spoken about since the beginning of March, which is the surge in energy prices across the globe and what it means for inflation, what it means for growth, and what it means for monetary policy. And we'll also have a look at SA inflation. We're going to start off with the standard set of charts that we've been updating since the war began. The first looks at the number of oil tankers passing through the Strait of Hormuz. The 7-day average is now sitting at 2. That's down from 200 prior to the war kicking off, and suggests that the Strait of Hormuz still at this point is effectively shut. And as a result of that, we're seeing energy prices surge across the globe. As an example, if you look at the month-to-date average of gasoline prices in the US, that's up 22% month on month. That alone is enough to add over 50 bips to inflation from the March reading in the US. And it's not just that crude prices are going up, refining margins are going up too. And that means that petrol and diesel are actually going up by even more than the underlying crude price increase as well. If we take a step back and look at a range of commodities that we're tracking throughout this, we'll see that energy prices, oil and coal have ramped both year to date and over the past month. Grain prices are ticking up too, along with aluminium. And on the flip side, we've got precious metals, which have pulled off quite materially. Gold, we think it's because it's liquid and because it's done very well. And if you go back over time and you look at various crises, often it's the case that gold will sell off immediately and subsequently rebound. And that's our base case for this time as well. PGMs getting hit because they are a reflection of internal combustion engine demand, which may well be affected by higher energy prices. And of course, they're linked more broadly to general perceptions of manufacturing activity, which too at this point are taking a knock. And that's best exhibited by having a look at the copper price over the past month, down 6%. We had noted before that it was stable. It does appear that we're now starting to see some revisions to global growth expectations. And with that, we're seeing some cyclical metals take a bit of a hit. Looking at markets, we have now seen a bigger pullback in equities. Over the past couple of weeks, we were wondering how the equity market had remained as stable as it had in an environment of this sort of scale of shock to energy prices. And we had been positioned defensively in our global multi-asset portfolios. Now we are seeing equities gradually pull down to the extent that since the bombing campaign has started, global equities are down 6% in dollars. The US is down around 5%. What's interesting is that high yield credit globally hasn't come down by much, and you would have expected in a normal sort of cyclical response like we are seeing in the equity market for high yield to contract more strongly than it had. And also interestingly, treasuries haven't provided the sort of protection that one would hope in an environment of a global sell-off. You would hope that treasuries would actually be up. Even so, that's all since the campaign has started. If you look year to date, the moves aren't particularly strong. We've got global equities that in the main are largely unchanged. We've got bonds that are largely unchanged and a dollar that's largely unchanged too. And so there is still an element, we think, of complacency out there. What we saw in the beginning of the year was a big ramp up, and to a large degree that's now been reversed, but there is still some risk out there. And one of the reasons there's risk, of course, is the shock to the inflation outlook. We saw US PPI numbers come out last week, and they confirmed that US inflation was picking up even ahead of what is likely to be a pretty sizable surge in inflation in March. And we can see that through the PPI numbers now sitting at close to 3.5%. Now, there was a Fed meeting last week, just like there was an ECB and a Bank of Japan meeting too. And based on the headlines, we can see that the Fed is becoming a bit more hawkish. This is based on a Bloomberg analysis of how hawkish or dovish the headlines are around the Fed over time. And there's been a clear shift in tone over the past couple of weeks. And with that, there's been a clear shift in interest rate expectations. And we can see what's priced into the market. At the end of February, what was priced in was 325 bip cuts from the Fed by September next year. That's now been completely erased. And what's currently priced in is no change in interest rates for the foreseeable future. So in effect, 3 cuts have been removed. And the reason for that is a sizable surge in inflation expectations. Again, using the bond market, we can back out what's currently priced in with regards to inflation expectations. And the market at this point is expecting inflation in the US to get to 5.2% next year, before subsequently reverting back to around 2%. And it's interesting in two respects. A, the scale of the increase in inflation that's currently in the market over the coming year is pretty sizable. But in addition to that, it is expected to be transitory. That's what's in the market. And so for our purposes, a key thing that we need to focus on is to what degree do these inflation increases become entrenched? To what degree do inflation expectations for the long term shift? Because in the US at the moment, it is still largely priced to be a short-term surge in inflation expectations. And that's quite different in Europe. It's very interesting. If you look at 10-year inflation expectations for the US, they've shifted up a little bit, the 10-year average, and that's because of an increase in the short term. If you look in contrast at Germany and the UK, inflation expectations over the full 10 years has gone up. And as a result, the ECB is now priced to increase interest rates 3 times by the end of the year. So there's this very interesting disconnect that's developed between Europe and the US. US inflation is expected to be transitory, and the risk there is that it becomes more permanent. In Europe, already the inflation expectations are that inflation increases will be persistent, and as a result, the central bank is already expected to act. Now, with all of that in mind, quite clearly there is a threat to global growth as a result of higher energy prices and higher interest rates than were expected in February, and there's a threat to inflation. With all of that together, you would expect that there should be some recognition in earnings forecasts. Earnings forecasts should have come down as a result of everything that we've seen, bearing in mind that it's now been 3 weeks. We haven't yet seen that. If you look at earnings expectations for the global indices, for the US and for Europe, they're all still pretty elevated. We've yet to see analysts pencil in the consequences of what we're seeing at the moment in the Middle East. And that poses a secondary risk to markets. We've seen the initial pullback as a result of high energy prices, but we haven't yet seen an adjustment to earnings forecasts. And as that adjustment occurs, we would expect that would place further downward pressure on global equities. Finally, in South Africa, we had the CPI reading for February come out last week. Inflation dropped from 3.5% to 3%. It was just a bit below the consensus estimate of 3.1%. And normally that would be good news and enough to attach a reasonable probability to the SARB cutting rates this week. Unfortunately, the outlook now is seriously in question. Based on the latest data, we're penciling in a petrol price increase of over 5 Rand a litre in early April, short of some intervention from government, and a diesel price increase of over 8 Rand a litre. And the consequence of that is that we think it will raise inflation to over 4.5% by April. That's based on our model. If oil is trading at $120 per barrel by the end of June, in that scenario, we expect that SA inflation will get to over 7% by September. So clearly, there's still a lot of uncertainty around that inflation forecast, but the trajectory at the moment has shifted materially in an upward direction, and that means that the SARB is not going to be in a position to cut anytime soon. If anything, at some point, they may well be looking to hike. And that is going to be the key focus from our perspective with regards to SA over the coming few months. Again, the question around the extent to which this inflation surge is likely to be temporary or not, how it's going to affect monetary policy, and in turn, how it will affect growth. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.